Before the 2008 financial crisis hit, there were 5 specific indicators that screamed crash coming. 5 charts that told professional traders to get out. Most people didn't know what to look for. But if you were watching these 5 indicators, you saw it coming months in advance. Right now, 4 out of those 5 indicators are flashing red again. The same signals, the same warning pattern. In this video, I'm going to show you exactly what those 5 indicators are, what they looked like before 2008, and why 4 of them are triggering right now in early 2026. Value proposition. By the end of this video, you'll understand the 5 key crash indicators that preceded 2008, how to read them, and what it means that 4 are currently showing warning signals. Let's break down each one. Indicator number 1, credit spreads. The first indicator is credit spreads. Let me explain what that means in simple terms. When companies borrow money by issuing bonds, they have to pay interest. The riskier the company, the more interest they have to pay. The difference between what a risky company pays and what the government pays is called the credit spread. When credit spreads are narrow, when risky companies can borrow cheaply, it means investors aren't worried about risk. Everything feels safe. But when credit spreads widen, when risky companies suddenly have to pay much higher interest rates, it means investors are getting nervous. They're demanding more compensation for risk. Before 2008, credit spreads started widening in mid-2007. Investors were losing confidence in corporate debt. That was the first warning sign. Right now, in early 2026, credit spreads are widening again. Not as dramatically as 2007 yet, but they're moving in that direction. Indicator number 1, red. Indicator number 2, financial sector performance. The second indicator is how financial stocks are performing relative to the overall market. Banks, insurance companies, investment firms. The financial sector is the plumbing of the economy. When the financial sector starts underperforming the broader market, it's a warning sign. Before 2008, financial stocks started falling in early 2007, a full year before Lehman Brothers collapsed. Investors who paid attention could see that something was wrong in the banking sector. The stocks were telling you these companies are in trouble. Right now, financial stocks are underperforming again. Regional bank stocks especially have been weak. Insurance companies are struggling. Investment banks are seeing pressure. The financial sector is sending the same warning signal it sent in 2007. Indicator number 2, red. Indicator number 3, commercial real estate prices. The third indicator is commercial real estate prices. Before 2008, the problem was residential real estate. Housing prices were in a bubble and then they crashed. In 2026, the problem is commercial real estate. Office buildings are in trouble because of remote work. Retail properties are struggling. Commercial real estate prices have been falling since 2023. And here's why it matters. Banks have hundreds of billions of dollars in loans to commercial real estate. If those properties lose value and those loans go bad, it creates stress in the banking system. This is the same dynamic as 2008, just with commercial real estate instead of residential. Before 2008, you could see residential real estate prices peaking and starting to fall in 2006. That gave you an 18-month warning before the crash. Right now, commercial real estate prices are falling. We're in the middle of that decline. Indicator number 3, red. Indicator number 4, yield curve. The fourth indicator is the inverted yield curve. I covered this in detail in a previous video, but here's the quick version. When short-term interest rates are higher than long-term rates, it creates an inverted yield curve. And historically, that signals recession risk. Before 2008, the yield curve inverted in 2006. 2 years before the crash, the bond market was warning trouble ahead. Right now, the yield curve has been inverted on and off since 2023. It inverted again in late 2025. The bond market is sending the same warning signal it sent before 2008. Indicator number 4, red. Indicator number 5, stock market breadth. The fifth indicator is market breadth. Market breadth measures how many stocks are participating in a rally. When the market is healthy, a lot of stocks go up together. When the market is unhealthy, only a handful of stocks carry the entire index higher, while most stocks are actually falling. Before 2008, market breadth started deteriorating in 2007. The S&P 500 was still going up, but it was being carried by just a few large stocks. Most stocks were already declining. That divergence, that's the index going up while most stocks go down, is a classic warning sign. Right now, we're seeing the same thing. The market indices are near all-time highs, but market breadth is weak. The so-called Magnificent Seven tech stocks are carrying the entire market. Most other stocks are flat or down. This is the one indicator that's not as clearly red as the others. It's showing warning signs, but it's not as extreme as 2007 yet. Indicator number 5, yellow leaning red. What this means. So let's recap. Before the 2008 crash, 5 key indicators gave advance warning. Credit spreads widening, financial sector underperforming, real estate prices falling, yield curve inverting, market breadth deteriorating right now in early 2026. Credit spreads widening, red financial sector, underperforming, red commercial real estate, falling, red yield curve, inverted, red. Market breadth, deteriorating. Yellow 4 out of 5 are clearly flashing warning signals. The 5th is getting close. This doesn't guarantee a crash. Markets can stay elevated even with warning signals flashing. 2008 taught us that crashes don't happen on a predictable schedule. But what it does tell us is that the same pattern that preceded the 2008 financial crisis is setting up again in 2026. And if you're invested in the market, you need to understand that the risk environment today looks similar to the risk environment in 2007, right before the worst financial crisis in 80 years. Disclaimer. This is educational analysis of market indicators and historical patterns, not financial advice. Call to action. 5 indicators warned of the 2008 crash. 4 are flashing red right now. 1 is yellow. These aren't obscure indicators. These are the same signals professional investors watch to gauge crash risk. Credit spreads, financial sector performance, real estate prices, yield curve, market breadth. If you want updates as these indicators develop, subscribe. Which indicator concerns you most? Thanks for watching. Check out the video on screen about the inverted yield curve, one of the 5 indicators I just covered, explained in more detail. I'll see you in the next one.